Okay, our third learning objective is that explain and applying underlying gap for inventory. Let's talk about. So the disclosure principle holds that a company's financial statement should report enough information for outsider to make information based decision about the company. That is called disclosure. It means company must provide its accounting method, whether it is using average, LIFO or FIFO. What do we mean by representational faithfulness? It means the company should report relevant and representational faithful information about itself, which means properly disclosure and substance of all material transaction impacting inventory. So it's not like that you are having barter system transaction here. Every kind of material transaction that have done and that impacts the inventory, you should disclose that one. And number third is, we call that consistency, which means in one year you are using LIFO and in other year you are using FIFO. So if you are doing this kind of practice, this is not consistency. Consistency means it requires the use of comparable methods for consistency of presentation from period to period. It's not like that when there is a high inflationary periods you use LIFO, when there is a deflationary period you use FIFO for tax purposes, right? Because in high prices period, in the LIFO result in lower income and lower taxes, so you use LIFO. When there is a deflationary period, then what you are using, you're using FIFO, because FIFO result in lowest income in deflationary or decreasing prices scenarios. So you must use consistent, and you describe if that is logical. If you want to change the accounting system, it is permissible by law. There is no law that restrict you from using either of the system. But if you want to change that, there's going to be a fairly logical reason behind that, and you need to disclose that as well in the footnotes of the balance sheet as well. So the disclosure method, that lower of the cost or market value, we call that LCM method, lower of the cost or market value. So the nickname is LCM. So it requires that inventory be reported on the financial statement at whichever is lower. So if its historical cost is lower, then you record it lower. If market value is lower, you record it lower, right? So disclosure in the accounting system for inventory is based on LCM, which is lower of cost or market value. Understand? So market value generally means replacement cost. For example, if you hold an inventory, you purchased inventory last year and it is still in your hand, and the cost of the inventory due to is expiry and all the stuff, it was 10,000, and now after it is not sold, the expiry is coming now, it is worth 8,000, right? So 2,000 are lost. You cannot say that okay, my inventory is higher, so my balance sheet is higher, my assets are higher. No, we have to report is using LCM method, which is lower of the cost or market value. If the market value or replacement value is lower, then you use the lower value. If the market value is higher, even then you use its cost price, which is more realistic. The question that should I think pop up in your mind, why we are using market value. If market value, it means we already sold the inventory, right? When we sold the inventory, then why we are using the word inventory, right? So that's why we explain it here. It means replacement cost. If we sell this inventory, which is represented by in the balance sheet, if we sell that inventory, it would be sell at 8,000. We call this replacement cost. Right? So understand it with illustration. So I just want you to pause the video and try to read this whole illustration and we solve it together. So suppose Family Dollar Incorporation paid 3,000 for inventory on June 16. By August 25, its fiscal year ended. The inventory can be replaced for 2,000. So they bought it 3,000 of the inventory, and that inventory is not sold, that is on the balance sheet. If this sell now, its value is 2,000, but still they didn't sell it. So its balance sheet must report 2,000 and decrease will be charged to cost of goods sold. The entry would be cost of goods sold to inventory. Simple. And that is the loss or expense that will go to the income statement. So income statement will go through the account name cost of goods sold, expense rise, debit, asset decrease, credit. That's why cost of goods sold to inventory. So here, how are we going to write it down here? Here, we write it down that whichever is lower, the purchase price was 3,000 and now it is 2,000 here. So 9,000 was our cost of goods sold. We also added due to impairment or lower of the cost value LCM method, we increase our cost of goods sold expense after sales here. The comparison of two accounting methods, laws, sorry not method, laws. So the global view is that in GAAP we call this market value is a replacement value, right? But under IFRS we call the market value as net realizable value. So recall our discussion regarding realized or unrealized loss, right? So it means if we realize or if we sell that inventory, it would be sold at that price, but you still did not sell it. So this is some kind of like unrealized value, unrealized condition here. Plus under GAAP, once you apply LCM rule, it means you lower down. If in our previous example when inventory it was 3,000, but due to the market value or replaceable value is now 2,000, we just write it down in description that its market value was 3,000, but now its cost was 3,000, but its realized value, its market value or replaceable value is 2,000, right? So but in GAAP this can never be reversed. You cannot write down that inventory, but now if inventory value is increased, so we cannot increase the value of inventory. For example, after some day the inventory value is now 2,600. So but LCM is applied, lower of the cost and the market value. So cost is already lower. No, cost is higher. So lower. If the replacement value is 2,600, you cannot write it. We just write it down 2,000. So let's read it here. Under US GAAP, once the LCM rule is applied to write inventories down to current replacement cost, the write-downs may never be reversed. In contrast with IFRS, some lower to the cost or market value write-down may be reversed, and inventory may be subsequently written up again, not to exceeding this cost original price. Okay, so that is a just small difference between GAAP and IFRS. So sometimes GAAP is also referred to as very rigid law. IFRS is more flexible. So this global view is just for your information. Okay, now decision guidelines. Decision guidelines are that which inventory system to use. So when you have used expensive merchandise, always use perpetual system for unit cost item, not average, not LIFO, not FIFO, right? Unit cost items. Let me just remove it. Okay, when you want to control the inventory by visual inspection and goods are unique as well, use periodic system. Just a guideline. If you're using expensive and you cannot control the inventory by visual inspection. You cannot go to the vault to see the gold items, diamond items, all this stuff. Then you use perpetual system for unit cost. And if you cannot control the inventory by visual inspection, then you use periodic. And normally it is used for low value item. There is a unique item but low value. In this case, you cannot go to the vault, every day to inspect that. Okay, I have this, this much diamond and this much gold. It's like that. So when unique inventory system items there, you can use specific unit costs. So for one of a kind object, because these are unique. For example, building cost. So the building cost is unique. Every building is unique. Its cost is unique. You can easily find out that its unique cost, make its an inventory cost unique as well. We just multiply with that cost. That's it. You don't have to find out which bricks come first or which areas like that. The whole item is uniquely built. So we call that unique inventory system, which is specific unit cost of method. So if most current cost of ending inventory is there and you want to maximize reporting income when costs are rising, always use FIFO. And there are just guidelines, okay? This is not a hard and fast rule. And if most current measure of cost of goods sold and net income you are interested in, or if you want to minimize the tax, use LIFO. It means in FIFO you are interested in balance sheet. In LIFO you are interested in income statement. So the viewpoint is different, right? So what if middle of the road approach for income tax and reporting, use average method, because that is lies between FIFO and LIFO. Okay, that's all from our side. So I'm going to be uploading assignment 6 on WeChat, and please respect the due date. I'm gonna be uploading the due date on WeChat and Blackboard discussion board as well. That is the end of the lecture. If you have any query, please do write in the WeChat group, or we can discuss it in our live Zoom session. Please do attend that. Until then, stay safe, stay at home, take care of yourself and your parents and your elders. Bye bye.